India's benchmark stock index, Nifty 50, has witnessed a significant downturn recently, plummeting over 10% from its all-time high in the last 2 months, after scaling over 30% in the first half of the year, especially after the June election result amid Modi 3.0 optimism. This decline can be attributed to several factors, including muted corporate earnings growth, expensive valuations, and concerns arising from global trade tensions. Elevated and persistent headline inflation, coupled with a hawkish stance from the Reserve Bank of India, has also weighed on investor sentiment. Despite these headwinds, there are glimmers of hope for a potential Nifty recovery, at least for the time being. Anticipated RBI rate cuts and the possibility of BJP victories in the Maharashtra and Jharkhand state elections might be one of the potential catalysts for a possible market rebound amid short covering and fresh value buying. The RBI's cautious approach to monetary policy, despite elevated unemployment and below-target core CPI inflation, has kept borrowing costs too high for too long, affecting Nifty earnings. However, recent signals from the central bank suggest a potential shift towards a more accommodative stance. Simultaneously, the upcoming state elections hold significant importance. A win for the BJP in Maharashtra and Jharkhand could bolster market sentiment and pave the way for further economic reforms. Also, it will consolidate PM Modi's leadership within the party, even with an authoritarian approach. The potential extension of RBI Governor Shaktikanta Das's term is also being perceived favorably by market participants. This continuity in RBI leadership is expected to provide stability and predictability in monetary policy. The combination of potential RBI rate cuts and favorable election outcomes could create a more conducive environment for businesses and investors, ultimately supporting a Nifty recovery. Market participants are eagerly anticipating RBI rate cuts as a potential catalyst for reviving economic growth and boosting investor sentiment. The central bank's current stance has been perceived as too hawkish, with interest rates remaining elevated despite concerns about slowing economic growth and high unemployment. However, recent signals from the RBI, including a less hawkish hold in the October MPC meeting, suggest a potential shift towards a more accommodative policy. RBI officially shifted to neutral mode from restrictive, indicating potential rate cuts in the coming months, even from next month. Expectations are building for cumulative rate cuts of around 200 BPS in 2025 to 26, with projections ranging from 50 BPs to 25 BPS on December 2024 to match with the US Fed, and to keep policy differential for stability in the USD-INR FX rate. RBI Governor Das generally does not provide any clear forward guidance like the Fed, but now may be preparing the market for the start of the next rate cut cycle based on core CPI, not total CPI. These anticipated rate cuts are expected to reduce borrowing costs for businesses and consumers, stimulating investment and consumption. Although RBI rate cuts could also potentially weaken the Indian rupee, it may be good for export-heavy Nifty earnings, making exports more competitive and providing a boost to the manufacturing and tech sector. At the same time, lower borrowing costs may be also negative for banks and financials to some extent due to their lending model. Almost 50% of Nifty earnings are from exporters and 30% from banks and financials. Simultaneously, the upcoming state elections in Maharashtra and Jharkhand are being closely watched by investors. Exit polls suggest a potential victory for the BJP in both states, but it may be very close or even the opposite, which could have positive or negative implications for the market. A BJP win would not only solidify Prime Minister Modi's position, but also potentially lead to bolder economic reforms aimed at improving productivity and attracting foreign investment, at least theoretically. The combination of RBI rate cuts and BJP election victories is being viewed as a potential turning point for the Indian stock market. This confluence of events could create a more favorable environment for businesses, boost investor confidence, and pave the way for a sustained Nifty recovery. Despite the optimism surrounding potential RBI rate cuts and BJP election wins, several challenges could hinder Nifty's growth trajectory. High valuations, persistent inflation, and elevated unemployment remain key concerns for investors. The Nifty 50 is currently trading at a price-to-earnings ratio of around 27, significantly higher than its historical average. This high valuation is a cause for concern, particularly in the context of subdued corporate earnings growth. While corporate earnings are expected to improve in the coming quarters, the pace of growth is likely to be gradual. Furthermore, inflation remains a persistent challenge for the Indian economy. Despite some moderation in recent months, consumer price inflation remains well above the RBI's comfort zone. The recent surge in food prices, driven by supply chain disruptions and seasonal factors, has added to inflationary pressures. The RBI's ability to cut interest rates aggressively is constrained by the need to keep inflation in check. Unemployment also presents a significant challenge. India's unemployment rate has remained stubbornly high, particularly among the youth. The lack of well-paying jobs is a drag on discretionary consumer spending and overall economic growth. Addressing the issue of unemployment will require structural reforms and increased investment in education and skills development. These challenges highlight the need for a cautious approach to investing in the Indian equity market. While the potential for a nifty recovery exists, investors should be mindful of the risks and avoid getting carried away by short-term market volatility. Navigating global uncertainties, the Russia-Ukraine war and U.S. election impact. The global landscape remains fraught with uncertainties, casting a shadow over the Indian equity market's outlook too. The escalated Russia-Ukraine war continues to disrupt global supply chains, fuel inflation, and weigh on investor sentiment. The conflict has also heightened geopolitical tensions, creating an environment of uncertainty and volatility in global markets. Trump 2.0 is another significant source of uncertainty for global markets. A change in administration could lead to shifts in U.S. economic and foreign policy, with potential implications for global trade, investment flows, and geopolitical stability. The transition period between administrations is often marked by heightened volatility, as investors assess the potential impact of policy changes. These global uncertainties are likely to keep investors on edge, leading to periods of heightened market volatility. The Indian equity market, despite its domestic strengths, is not immune to global headwinds. Investors should brace for continued volatility in the near term as these global events unfold. Technical outlook: support and resistance levels for Nifty. From a technical standpoint, the Nifty 50 index is currently at a crucial juncture. It faces strong resistance at the 24,000 level, while finding support around the 23,000 mark. A decisive break above 24,000 could signal further upside potential, potentially targeting the 25,000 and even the all-time high of 26,200 to 26,500 levels. However, a failure to sustain above 23,950 could trigger a downside correction again, potentially leading the index towards the 23,000 to 22,450 support zone. Further weakness below this level could open the door for a deeper correction towards 21,000. The near-term direction of the Nifty 50 will likely be influenced by a confluence of factors, including corporate earnings, global market sentiment, and developments related to the Russia-Ukraine war and Trump 2.0 policies. Conclusion: Nifty's path to recovery, a balancing act. The path to recovery for the Nifty 50 index is likely to be a balancing act between domestic tailwinds and global headwinds. While the potential for RBI rate cuts and BJP election wins offers a glimmer of hope, challenges related to high valuations, persistent inflation, and global uncertainties cannot be ignored. For a sustained recovery, corporate earnings growth needs to pick up pace to justify current valuations. The RBI's stance on interest rates will also be crucial in supporting economic growth while managing inflationary pressures. Furthermore, navigating the complexities of the global landscape, particularly the Russia-Ukraine war and Trumponomics 2.0, will be paramount. Investors should adopt a cautious yet optimistic approach, focusing on companies with strong fundamentals and growth potential. Staying informed about both domestic and global developments will be essential for making informed investment decisions in these uncertain times.